From the outset of his presidency, Donald Trump has championed an unwavering America First doctrine, pledging to make America great again. He frequently touted the stock market as not just a symbol, but the core engine of America's economic might. For instance, during a CNBC interview in December 2024, Trump said, "Stock market is very all of it, all of it together. It's very important," and smiled that it was an honor to be here in New York Stock Exchange. At a speech to Congress in March 2025, Trump defended his tariff strategy by declaring, "Tariffs are about making America rich again and making America great again. There will be a little disturbance, but we're okay with that." Yet, despite pledging economic revival from day one, starting on day one, we will end inflation and make America affordable again, he asserted during his campaign. Market performance has not fully lived up to his promises. Notably, the world's largest asset manager, Vanguard, observes that the U.S. stock market is being overtaken by its neighbor, Canada. That trend underscores a growing disconnect between Trump's optimistic economic messaging and the unfolding reality. Today, Bloomberg has reported that Canada's stock market is significantly ahead of the U.S. in 2025, and that trend could persist for as long as the next 5 to 7 years, according to Joe Davis, chief economist and head of investment strategy at Vanguard Group, one of the world's largest asset managers. Davis argues that as artificial intelligence, AI, enters a more mature stage, investors will need to think differently about where they put their money. Early on, the biggest gains typically go to the companies building the technology. But over time, it's often the businesses that use the technology most effectively, lowering costs, increasing efficiency, or opening new revenue streams that deliver stronger investment returns. That is why Davis says the odds are tilted toward markets outside of the United States, including Canada. He adds that the more bullish you are on AI, the less you would weigh technology in your portfolio. In other words, if you believe AI will be transformative, you don't just buy the obvious tech giants. You look for industries quietly gaining from it. So far this year, the S&P/TSX Composite Index, Canada's main stock market benchmark, is up more than 16%. By comparison, the S&P 500 in the U.S. has gained less than 10%. An index is simply a basket of stocks used to track overall market performance. That kind of gap is unusual. Over the past decade, U.S. stocks have typically dominated. The last 2 times Canada pulled ahead by this margin were in 2016 and 2022, both periods when commodity prices surged. In 2025, gold is once again the driver. Prices have reached all-time highs as global investors seek safe havens during trade disputes and geopolitical tensions. Safe haven assets are investments people buy when they're nervous about risk. Gold has played this role for centuries. Because Canada is home to many of the world's largest gold miners, this has fueled a 52% gain in the materials sector. At the same time, Canadian corporate earnings have stayed stronger than many expected despite new U.S. tariffs disrupting trade. Canada's major banks, nicknamed the Big Six, remain pillars of stability. 5 of them beat analyst profit forecasts in the third quarter. When banks surprise on the upside, it usually signals broader economic resilience since they sit at the center of lending and investment activity. In contrast, the U.S. rally has narrowed to a handful of dominant names, the Magnificent Seven tech stocks, which include Apple, Microsoft, and Nvidia. After surging 107% in 2023 and another 67% in 2024, they've cooled to just 11% growth in 2025. These companies are so large they can swing the entire market. So when they slow, the broader index feels it. Yet their stock prices remain extremely expensive. They trade at about 35 times projected profits for the next year. The S&P 500 overall trades at 25 times while Canadian stocks average only 18. This ratio, called the price to earnings or PE multiple, shows how many dollars investors pay for $1 of earnings. The higher the number, the more optimism and risk baked into the price. Davis believes this valuation gap will matter because AI is following a familiar pattern. He compares it to electricity in the 1920s. At first, electricity companies benefited directly, but the real profits later flowed to manufacturers like Ford and General Motors who use electricity to transform production lines. The lesson: the real winners of new technology may not be its inventors, but its most effective users. Similarly, Davis expects AI adoption to favor industries outside U.S. mega tech, particularly those in countries like Canada that have more diversified economies. For global investors, this means looking beyond the U.S. Canada offers exposure to sectors like banking and services, which can integrate AI without being weighed down by extreme valuations. Its resource industries also provide diversification that the tech-heavy U.S. market lacks. We think this has some legs. They're going to be up and down in this, Davis said. But if we're right, the general outperformance of Canada over the U.S. is by serious percentage points. If Canada's stock market keeps beating the U.S. for several years, it could have some real consequences for the American economy. The first impact would likely be on investor confidence. When Canada's market gives better returns, big global investors may shift more of their money north of the border. That could make it harder and more expensive for U.S. companies to raise money by selling shares, which in turn could slow down things like stock buybacks, new public listings, and even corporate investment. There's also a psychological effect. For years, Americans have been told that a booming stock market is proof of economic strength. If Canadian stocks consistently outshine Wall Street, it could chip away at that sense of confidence. That matters because when people feel less wealthy, they tend to spend less, and consumer spending is a huge part of the U.S. economy. Vanguard's economists think the reason Canada may pull ahead is because the next stage of artificial intelligence growth will reward users of AI more than creators of it. Canada's economy, with its strong banks, services, and natural resources, could adapt faster to these changes. While the U.S. market is heavily tied to expensive tech giants that have already slowed down after years of rapid gains. On top of this, President Trump's tariff policies are adding more uncertainty for U.S. businesses, which could further discourage risk-taking and investment. The U.S. still has advantages such as its huge consumer base and strong corporate earnings. But if commodity prices like gold keep rising, a big plus for Canada, while American tech stocks remain overpriced, Canada could continue to hold the upper hand. That's all for this video. Thank you for watching. As an independent channel, we don't have corporate backing. We rely on your support to keep going. If you found this video valuable, please give it a thumbs up and leave a comment below. It really helps more people find our work. Thank you so much for being part of our community. Check out the next video on your screen. We picked it just for you.